Hello, and welcome to the WHSS video series on steps to gaining housing. My name is Dan Mills, and I'm a housing navigator. Today, we're going to discuss credit scores. Okay, let's get into it. What is a credit score, and how does it affect my ability to get a place to live? First, a credit score is just a number assigned to determine how you manage your debt. Lenders use this to calculate the risk that they are taking when you borrow money and things of value. It matters in housing because landlords are basically using that score to calculate their risk when you borrow or rent their property. Many landlords are using a score of 650 as the benchmark of what they look for in a potential tenant. So what's your credit score, and how do you get it above that line in order to get housing? A question a lot of us don't really think about. A credit score is just a number, but what makes up that score is in many ways more important to understand than the actual number itself. If you can understand that, then you can learn a few tips to help raise that score and get better housing. So let's talk about credit scores. First, the range is going to be somewhere between 300 and 850. 750 to 850 being considered excellent, 700 to 749 considered good, 650 to 699 considered fair, 600 to 649 poor, and anything below 600, well, that's very poor. If you have never used credit or participated in the system that measures or reports credit, then you may actually have a credit score of 0. That tells lenders that there's no measure of your ability to manage debt, and there is a fair amount of risk to lending money, or in the housed world, property to you. Remember that the reason all this matters is that most landlords are using a credit score of 650 in their screening criteria. If your credit score is below that, they may ask for a cosigner on a lease or deny you. If it's not possible to get a cosigner, then we need to talk about how you can improve your credit score. And to do that, you need to understand how it's calculated. Your payment history makes up about 35% of how your score is determined. So making sure that you pay creditors on time is huge. Every month that you pay your bills on time, your score goes up. How much depends a lot on other factors, including what your score is now. So, believe it or not, but the formula for this actually benefits individuals with lower scores more for paying on time. So there's a big incentive to start paying your bills on time if your score is lower than you'd like it to be. Your credit utilization ratio, or how much of your credit allowance you have versus how much of it you're actually using, makes up the second largest share of your credit score at 30% of that formula. Let's use the example of a bucket. Think of your total allowable credit as the size of your bucket. If you fill the bucket completely full, then you're carrying all that you can, and you can't take on any more without overfilling your bucket. But if you only fill your bucket a third or halfway, then it means that you have room to carry much more if needed. What that means is that if you're only using a small percentage of your available credit, then there is a lower risk that you're overburdened and therefore more likely to pay. Credit reporting agencies use 30% as a target for this. So, to put it simply, if you have a credit card with a $5,000 limit and you keep your balance at less than $1,500 or 30%, then this will have a positive influence on your overall credit score. So even if you can't pay off your credit cards every month, at least make an on-time payment and try to get it to less than 30% of the total limit. The next determining factor is the length of your credit history. This is something that you can't change in a positive way quickly, but you can lower your credit quickly if you don't understand this part, since it makes up about 15% of the formula. If you're young and you haven't established credit yet, then this really matters. Start your credit history as soon as you can financially do so. I work with a lot of older adults all the time that have never had a credit card or taken out a loan for fear that they might end up with bad credit. Although it's possible to damage your credit by taking too many loans or credit cards at one time, it is important to understand the risk and the potential benefit of establishing a credit history as soon as you are ready. It's even more important to understand that if you close accounts that you have had for a really long time, this will lower your credit because you just eliminated a lengthy part of your usable credit history. A good trick here is to keep accounts that you've had for a really long time active. So if you have got a credit card 10 years ago and another one 2 years ago, consider keeping the one that you've had for the longest time if you're looking to cancel one of them. Now, the kind of credit, or what's referred to as credit mix, and any new credit you open each make up another 10% of this formula. By credit mix, what we mean is the kind of different credit that you use. If you remember from a past video on what is credit, we talked about this. Installment loans like auto loans and mortgages, revolving credit like credit cards, and even service credit like membership fees and things like cable or utility companies that report to credit bureaus. This is another reason why you may see a dip in your credit score each time you take out a loan. Everything you do involving your credit score has an effect on it, whether it's for better or worse. Some things affect your score longer than others. For example, applying for a new credit card will lower your score almost immediately, but for only about 3 months, provided that you don't max it out or miss payments. Even closing a credit account will lower your score for about 3 months or so. Missed payments or defaulting on a loan will lower your score a lot for about 9 to 18 months. Foreclosures will take a hit for about 3 years, and bankruptcies, well, that'll take 7 years before you even begin to recover. So knowing all this can actually help you raise your score at just the right time. Remember, we're looking for housing, and landlords are going to run a credit check when you apply for housing. First, make sure you are current on all your payments by paying your bills on time. Don't apply for any new credit cards or loans for at least 3 months before you apply for housing if you can avoid it. And don't cancel any accounts that you currently have open if at all possible. Also, get a free credit report and check for errors as soon as you even think about looking for housing. We'll talk about how to fix errors in a future video. Remember, the bad things happen fast and the good things take time. Credit is no different. Thanks for watching. See you on the next video.